Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, Steve Hamoen, here to provide you with insights sourced from reputable news outlets to help you stay informed and make well-informed decisions. This podcast is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their homeownership dreams. Visit realapproved.ca to learn more about how their experienced team can assist you with your mortgage needs. Let's dive into today's episode. Today, we're focusing on the upcoming interest rate announcement from the Bank of Canada, which is scheduled for January 29th. Currently, the overnight lending rate stands at 3.25%, a decrease from 5% a year ago. This rate is crucial as it influences the interest that banks and lenders charge for loans and mortgages. So, will there be another rate cut? According to TD economist James Orlando, the data suggests a potential cut of 25 basis points, or 0.25%. Orlando stated in a recent news release that given the current interest rate environment in Canada, the Bank of Canada might opt for a slower pace of cuts. He noted that the bank had previously reduced rates by 50 basis points in both October and December. The Bank of Canada's strategy over the past year aimed at controlling inflation by raising the overnight lending rate. The objective was to bring inflation down to 2%, which was achieved as higher interest rates led to reduced consumer spending on travel, home renovations, and dining out. Orlando also mentioned that as interest rates have decreased, consumer spending has picked up, with more people willing to spend on dining, services, and physical goods. The latest figures from Statistics Canada show that the annual inflation rate dropped to 1.8% in December, which was lower than anticipated. Reuters reported that a further decline in inflation could prompt the central bank to cut rates again next week. However, Bank of Canada Governor Tiff Macklem indicated last month that any future rate cuts would be gradual. A Reuters poll of economists suggests that many expect the bank to lower the rate again next week. An interesting factor influencing spending is the federal GST/HST tax break that began on December 14th and will last until February 14th. This tax break has led to reduced prices on items such as alcoholic beverages, children's clothing, toys, video game consoles, and restaurant meals, particularly in provinces with the harmonized sales tax. For Canadians with variable rate mortgages, a rate cut means that more of their monthly payment goes toward the principal, reducing the overall interest paid over time. However, for those with fixed rate mortgages, a Bank of Canada rate cut does not have an immediate impact. If the Bank of Canada decides to hold the lending rate at 3.25%, it would mean little change for the average Canadian. Orlando believes that the bank may need to start holding rates steady in the near future, possibly as soon as the next meeting in March. He predicts that by the end of 2025, the bank will have cut the lending rate by a total of 100 basis points, bringing it down to 2%. The next interest rate announcement from the Bank of Canada is scheduled for March 12th. We'll be keeping a close eye on developments and will update you with any significant changes. In a significant move, TD Bank is planning to sell approximately $9 billion in residential mortgages. This decision comes as the bank seeks to adjust its balance sheet in response to an asset cap imposed by United States regulators. The asset cap is part of a settlement agreement following charges of inadequate money laundering controls. The portfolio that TD Bank is looking to sell primarily consists of jumbo mortgages, which are loans extended to United States homeowners with strong credit profiles. According to reports from BNN Bloomberg, bids for these loans are expected to be received by next week. While a TD spokesperson declined to provide additional comments to Canadian mortgage trends, they confirmed the accuracy of the details reported by BNN Bloomberg. This development follows a significant event in October 2024, when TD Bank agreed to pay over $3 billion in fines and accepted growth restrictions in the United States as part of its settlement. The Office of the Comptroller of the Currency, the United States regulator overseeing TD Bank, imposed an asset cap that limits the bank's ability to expand its retail business beyond its current asset levels. To comply with this asset cap and maintain operational flexibility, TD Bank is undertaking a restructuring of its holdings. This restructuring includes selling up to $50 billion in lower-yielding investment securities. The proceeds from these sales will be reinvested to optimize the bank's balance sheet and meet the regulatory requirements. The decision to sell such a substantial amount of mortgages is a strategic move by TD Bank to align with regulatory expectations while ensuring the bank's continued growth and stability. It's a reminder of the complex regulatory landscape that financial institutions must navigate, particularly when operating across international borders. In Ottawa, the housing market has witnessed a remarkable surge, with a 75% increase in new housing sales in 2024 compared to the previous year. This significant growth has been primarily fueled by the demand for multifamily units, particularly townhouses. According to a recent report by Zonda Urban, the sale of townhouses skyrocketed, with 1,997 units sold in 2024, marking a 72% increase from the previous year. The sales momentum for townhouses peaked in the fourth quarter, with 858 new townhouses sold, reflecting an 84% increase from the same period in 2023. The west and southwest regions of Ottawa, notably Barrhaven and Stittsville, were key areas driving this demand, accounting for more than half of all townhouse sales. Meanwhile, Canada and Orleans contributed an additional quarter of the market activity. Affordability has been a crucial factor in this market growth. Stacked townhouses, which made up nearly half of the new townhouse inventory, were sold at an average price of $387,150. These units offered an average size of 1,066 square feet. In contrast, traditional townhouses, which are more spacious at 1,801 square feet, were priced higher, averaging $588,334. Interestingly, the demand for townhouses outpaced that for new condominium apartments, which, despite experiencing a 204% year-over-year increase in sales, remained a smaller segment of the market. Only 82 new condominium apartments were sold in 2024, leaving 225 units unsold at the year's end. Zonda Urban's report attributes part of this rebound to a strategic shift by developers in late 2023. Developers adjusted their pricing and product offerings to focus on more compact and affordable townhouse options, aligning with buyer demand. As Pauline Learman, Vice President of Market Research at Zonda Urban, noted, ground-related townhouses really are the engine of this market. 14 new townhouse developments launched in 2024, with an impressive 67% absorption rate of released units by the end of the year. The average price of these newly launched townhouses stood at $490,963. The report anticipates that the strong demand for townhouses will persist into 2025, driven by relatively affordable price points and the continuing appeal of suburban communities in Ottawa. In a recent report by Oxford Economics, Canada's housing needs are projected to decrease by 500,000 homes by the year 2035. This significant change is driven by an anticipated decline in the country's population, as outlined in the research. The revision to Canada's long-term housing supply needs is based on a predicted 0.2% annual population decrease over the next 2 years, largely attributed to recent changes in immigration policy introduced by the federal government. According to Oxford Economics, Canada's population is expected to decline to 41.1 million in 2026 from 41.3 million in 2024. This marks the first population decrease since Confederation in 1867. As a result, the household formation forecast has been revised downward from 2.9 million to 2.5 million between now and 2035. The research paper, authored by economists Michael Davenport and Tony Stillo, Director of Canada Economics at Oxford, suggests that about 500,000 fewer homes will need to be built by 2035 to rebalance the housing market. In October, the federal government unveiled its 2025 to 2027 immigration levels plan, which lowers the target for permanent resident admissions to under 400,000 annually. This represents a decrease of more than 20% compared to the previous plan. The updated plan also aims to reduce the share of temporary residents to 5% of the population by the end of 2026. These new targets are expected to lead to an unprecedented net outflow of 445,000 temporary residents each year over the next 2 years. Oxford Economics notes that this marked slowdown in immigration levels is expected to result in 1 million fewer people living in Canada by 2030 compared to previous estimates. Not only will this have an impact on housing needs, but it is also expected to slow GDP growth in 2025 by 0.1 percentage point to 1.3%. The growth rate is anticipated to be an average of 1.7% in 2026 and 2027, which is 0.5 percentage points lower than previously expected. The report highlights that the weaker growth in consumption and housing due to a smaller population will dampen the boost to Canada's economy from lower interest rates and stronger global demand. However, the reduction in housing needs over the next decade is expected to help close the housing supply gap, which has struggled to keep pace with demand in recent years. Oxford Economics forecasts a less daunting wave of new home building in the coming decade, projecting housing starts to crest just below 300,000 units later this decade, compared to the 350,000 range in its previous forecast. With new home building having slowed in the second half of 2024, Oxford expects that activity will likely continue to cool through the winter due to the lagged impact of past interest rate hikes and improving, yet still soft, housing demand. Additionally, escalating building and material costs are leading many developers to delay or cancel new projects, particularly multi-unit dwellings in Toronto and Vancouver. However, as interest rates continue to decline, building costs stabilize, and government initiatives to address Canada's chronic housing shortfall take effect, Oxford predicts that housing starts will gradually increase, positively impacting affordability. The authors of the report conclude that stronger growth in housing supply than demand over the medium term will cause house prices to rise at a slower pace than incomes on average. Despite a smaller population over the next 2 years and slower population growth thereafter, it is expected to take around a decade to restore housing affordability at the national level. This report provides a comprehensive look at the evolving landscape of Canada's housing market, influenced by demographic shifts and policy changes. It's essential to consider these factors as we navigate the future of real estate and housing in Canada. Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate. Before you go, a quick reminder. Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your home ownership goals. Catch you next time and stay informed with the latest industry insights.